Hello guys, welcome back to another new video here. So in this class, we are going to discuss about an issue of shares, which is an introduction towards the issue of shares, which we will discuss. This corporate accounting is a topic which is majorly comes from a word company. Because previously in the old syllabus, this corporate accounting is named as company accounts. Now it is changed to corporate accounting, that is company. What is meant by company? Here, come means together. Coming together. Pani in Italian term, it is Spanish means for bread. Coming together for bread, for a meal. It is known as company, which is derived from the word. Then, while starting a company, each and every company needs some person to incorporate it. So, we will call them as promoters. We will call them as promoters. Who are promoters? Can you tell, Darshini? Who are called promoters?
One who invests in the company.
Good. One who invests in the company or taking a partnership in the company or a ownership in the company, we will call them as promoters. So we will write down those individual who start the company and they are part of ownership and management. This is known as basically a promoter. It means in a layman's language in simple terms. What is a promoter? As per the definitions of a Companies Act, it is completely different. I am simply talking about what you need it from accounting point of view, who is basically known as promoters. Then, which law governs the companies? Which law governs all the companies in India? Can you tell? Those who are watching recording also, just you can also take part of it. Which law governs the companies?
The Companies Act 2013.
Companies Act 2013 is an act which governs the entire. It comes under Ministry of Corporate Affairs, MCA. Ministry of Corporate Affairs, it comes under the Companies Act. Even LLP is managed by MCA. LLP is governs under the category of Ministry of Corporate Affairs. Okay. Now, basically, we will getting into the what are the basic features of a company in a simple terms. We will see. The main idea of a company is as a separate legal entity. A company is a separate legal entity. If it is a separate legal entity, we will treat them as a person, but we will not treat them as a natural person. We will treat them as artificial person. Okay. That person can only, that is a company, can only be incorporated by the nature of law, by only the nature of the law. Next, how we have the name, how the some person, natural person is having the name, the same way company is also having the name, company is also having the signature. It has name and a signature. In company's form, this signature is known as common seal. Now they have made it as optional. Before 2015, it is a mandatory one. After 2015, that is post 2015, they made it as an optional thing. Next one. It has perpetual succession. What is a perpetual succession? Okay, that is simply known as ownership is transferable. Ownership is transferable. That's the next feature we are having. And it means that it is not affected by change in ownership. Company will not affect if the owner changes. Okay. This is an important thing which we will be discussing on the based on the features of the company. Now, getting into the next topic, that is the types of company. I'm not going to spend too much time on the types of company as you have already studied in those your group 1, that is law and business law and ethics. So basically a company is of majorly you can tell as public company and private company. These are the two companies which we will be having. Public company, we will use, for example, A Limited. When we have only limited, it is public company. When we have A PVT Limited or A Private Limited, when we have private limited, it is known as private company. There is a one more thing which you need to discuss along with correlate with the stock market, that is a share market thing. All listed companies or public companies. Okay, but what is a public company and what is a private company? That's a main thing. Public company means they can collect money, they can accept the money from their public. Private company is something which we have a restriction that we should not collect any money from the public, that is from the private persons. So whenever the companies comes to the listed, if I say listed, it should be either in NSE or BSE or both. What is NSE? What is BSE? What is NSE, Darshini, and what is BSE?
NSE means National Stock Exchange.
National Stock Exchange, good.
BSE, I have
Then
no idea.
BSE means Bombay Stock Exchange. One of the oldest stock exchanges in India is Bombay Stock Exchange. The indicator to identify Bombay Stock Exchange is Sensex. The indicator to identify the NSE is Nifty 50. Nifty 50. Okay, the top 50 companies is a thing. Nifty is a thing. We will take it as an indicator to measure. Okay. A public company, basically a public company, if you take, I'll just give you a revision on what we have studied in the law. The basic thing is a public company should have at least 7 members. They should have at least minimum 7 members should be there. Next, these 7 members, there is no restriction in the members. They can accept 1,000 members also in their company as their members. Okay. Then one more important thing is they can accept the money from their public. Okay. Next thing I want to discuss is slightly I will go after some time to private company. Before that, I want to give you a clarity on the public as well as public sector as well as private sector. Public ownership, public sector means you can say public companies, or we will take it like this. Public sector means government sectors, companies owned by state government, companies owned by central government, partly by state, partly by central government, okay, and public companies. Public companies. Under the public companies, we have 2 criteria. One is listed public company, one is unlisted public company. One is listed public company, and the next one is unlisted public company. Private sector means owned by private person, or means owned by an individual, like Reliance Industries Limited. Everything will comes under the Reliance Industries Limited. Limited only, it is a private sector. Okay. Reliance Industries is operated by Mukesh Ambani, Nita Ambani, and their sons. This is known as private sector, but it is a company which is limited, means which is listed in the stock exchanges. So private sector also we have 2 company. One is public company as well as private company. Private company, we have a restriction. We have a major restriction that to invite public for subscription. Invite public for subscription. We should not invite the public to subscribe to their shares if it is a private company. So, public company, there is no restrictions at all. They can collect the money. So, whenever the company comes to the stock exchanges through IPO, that is initial public offering. Little bit later, we will be getting into a deep meaning of an IPO. Okay, there is no restrictions at all if it is in case of public company. Are you able to understand the difference between public sector and private sector and the public company and private company?
Yes, sir.
Yes. We will move on to another type of, which we will also have different types of companies. 1-person company we are having, small company we are having. Okay, these are the different companies which we are having. Majorly we are having a OPC. There is no thing which is depending on the OPC, we will do an accounting. Okay, we will majorly do an accounting for public company, or we will majorly do an accounting for a private company. OPC is also classified under the private company. Small company is also classified based on the numbers. If the turnover and if the paid up share capital is less than 4 crores, if the paid turnover is less than 40 crores, then only I will treat them as a small company. So here the major two types of companies, public or private. It's a majorly two companies. That's a simple thing you need to understand here. Okay. Next. What are the regulatory framework? Who regulates what? That's what the major thing we will be discussing here. Here the first thing is it will comes under, obviously we will say it comes under Companies Act 2013. Next, in Companies Act 2013, this entire accounting perspective will come under Chapter 9. The Chapter 9 is known as Accounts of Companies. Under that chapter, we will be learning the legal perspective of the company to maintain the and preparations of the financial statements. Preparation of financial statements. Okay, what are the relevant section to it? A relevant section to it is from section 128 to section 137 is a relevant section under chapter 9 of the Companies Act. Along with this, we will study schedule 3 of the Companies Act. What is the schedule 3 of the Companies Act? Which provides the format of financial statements. That's our next chapter. That is our next module in your material is preparations of a financial statement as per schedule 3. That is format of financial statements. Okay. Is there only regulatory framework that Companies Act 2013 is required? No. Along with this, we are having one more regulatory framework, that is company rules. What are the company rules? The company rules is something which defines the rules and regulations towards the company. Okay, basically we are following the company accounts rules 2014. This is a basic rules which we are following to provide the important rules regarding accounting. These rules will provide an important section or important rules regarding accounting. Okay. Next, and along to do an accounting, we are having some other rules also to provide dividend, because a companies needs to provide dividend as a part of their profit sharing towards the members or towards the shareholders of the company. At the time, the companies will follow our rules of companies declaration and payment of dividend. This is a rules which has followed by the company. The same rules 2014. Okay. And there is something called CSR. Can you know what is the CSR, Darshini? What is the CSR? Those who are watching recording also, you can also participate. What is the CSR? CSR means corporate
Social responsibilities.
Corporate social responsibility. Why there is a corporate social responsibility? Because the companies are earning huge amount of money based on some turnover limit as fixed. If they go beyond this turnover or the paid up share capital or the net worth, they need to provide that some part of the profits, some part of the net profits towards the society as a responsibility for the corporate governance. So that is basically around 2% of the net profits of the past average 3 years we will take and we will provide it to the public as a corporate social responsibility. This entire thing will be covered under your law papers. That's not a big deal here. Okay. And this will comes under the same rules companies CSR rules. I'm shortly writing as it elaborately if I want to write, that is corporate social responsibility rules. In short, I will write company CSR rules 2014. So basically, these three rules is giving a importance towards an accounting in this entire company's corporate accounting curriculum. But here and there, we are having more rules also in this thing. Okay. Next regulatory frame, which framework which we are having is accounting standard. What is an accounting standard? Basically, we will study only two types of accounting standard. Here, there is two difference of accounting standard. Here is one is AS and the next one is Ind AS. This I will elaborately cover at the end of the final module, module 5. Okay. Simply you need to know there is something called AS, there is something called Ind AS. Okay. Next. It's a basic thing which you need to remember. So we will now go into the next part, that is your next topic for our discussion is how the company is raising the capital. That's a question I want to throw to the audience, those who are attending live also, those who are watching in the recording also. How I can raise the capital? Basically of how many types? Just think about it quickly and get back to me. How many ways I can do a raising of a capital? So it is basically of two. One is owned capital. Next one is borrowed capital. Next one is borrowed capital. If it is owned capital, it is my money, that is owner's money. Okay. And we will treat them as by on this, we will go for the God, it will go to the part of profit sharing, it will go. So this we will name as share capital. Name as share capital. If it is a borrowed capital, that is lender's money. It is whose money? Lender's money. Lender's money is inclusive of banks' money, financial institutions, or some other private parties we will take. This, based on the lender's money, we will provide them on fixed interest at the rate of per annum we need to provide it to that person. That lender's money we will known as debentures. Basically, in your thing, you are going to study about the share capital and then you are going to study about the debentures. It's a basic major two concepts which you're going to study under this chapter. Okay. Next. First, before getting into the next topic of a share capital, I just want to give a practical insights of how you are going to work in the practical manner. So basically, if the company it gets to if they want to comes to the stock market, okay, if they want to come to the stock market, that is a share market, they need to be listed. The term which they are using towards the listing is IPO, initial public offering. They are coming to the share market for the first time, initial stage. So we will call them as IPO. They need to file their prospectus in this SEBI, that is Securities Exchange Board of India. Okay, you may have a doubt that I need why the company is come to IPO, because I don't have a surplus funds to run my business. I don't have sufficient funds. I need more and more capital. I may have a different plans to explore or to expand my business. To expand my business, I don't have a sufficient enough cash. That one thing I can do. Then you may have a doubt that the company which has already listed, if they needs more money, what they will do? They will again come for a public offering. That public offering we will name as further public offering, FPO, further public offering. First time if they coming, if we call them as initial public offering. If they come again and again repetitively, we will call them as FPO, further public offering. Okay, we will take one company and we will go through what they are trying to decode it under this. Okay, just I'm going to getting into the practical insights of an IPO. What is an IPO? IPO is an initiative by which private company becomes a public. What it is basically, a private company becomes a public. A company becomes a public when it started selling its shares in the market for the very first time. Okay, selling a shares is like selling a portion of his stake to the investors for the company. Basically, there is of two market. One is primary market, one is a secondary market. IPOs are launched in the primary market, that is for the first time. Secondary market is something which we are after the IPO, we are purchasing the shares, no, we are selling the shares, no, that type is known as secondary market. So the shares which we are buying right now and we are selling is a secondary market. Those we are applying for them for an IPO, it is known as primary market. Why does company launch an IPO? IPO route is a route to generate fresh equity share capital to further for the company to further its business. To expand this business, they need this money. Okay. Next. Who can invest in the IPO? That is a practical aspect. Next thing we will be discussing on. Okay. Who can invest in the IPO? Investors are divided into three major categories. Okay. One is QIB. What is QIB? That is qualified institutional buyers. Qualified institutional buyers. This qualified institutional portion comprises of mutual funds, DFIs, that is domestic financial institution. Who comes under domestic financial institution? Banks will come, financial institutions will come, insurance companies will come. Do you know one thing, that each and every sector who needs, even insurance company, they will also invest in the stock market. They will also invest in the bonds. They will also invest in the corporate bonds. They will also invest in the government bonds. The money will becomes double only by way of investment. That too majorly we will get an more percentage of return basically in the stock market, and other financial sectors also be there. That is PPF, public provident fund, and pension fund. These are the different categories we are having. But basically, majorly, they are going to deposit your money in the stock market. They are going to infuse the funds in the stock market. Next is foreign institutional investors. Foreign institutional investors is the next thing we are having. That is FII. We will call them as FII. Next thing is non-institutional investors. Non-institutional investors, we will simply call them as NII. We will call them as non-institutional investors. That are the companies, individuals other than retail investors. That is known as a person who is purchasing more. There is some limit is there. 2 lakh, 5 lakh limit is there. If they go beyond this 5 lakh, that individual is known as individuals other than retail investors and others. Third type of investors is a retail individual investors like me. I am also investing in a stock market, that I will comes under the category of retail individual investors. Okay. So next thing, what happens after the IPO period? Once the IPO subscription period is over, let's say they will open for 3 to 4, minimum 2 to 4 days they will have. The shares are listed, exchange after a couple of days. After the listing, the shares are traded freely in the market during the market hours. This freely in the market is known as secondary market. It's known as what market? Secondary market. Basically, if I want to company shares, what you are studying in accounting perspective, to do a journal entry by having a 3 to different 4 methods of collecting the money from the public, and what is currently happening in the situation, it's completely different. Okay, next we will getting into the what is the process of investing in an IPO online. I want each and everything to be learned it in a practical manner. None of them should be omitted. Okay. First thing is to choose an IPO. There is many IPO will come and go. What IPO you need to invest? Before few months ago, there is a company called Tata Technologies. Tata Technologies is a one company which has comes for our listing after nearly 20 years. After 20 years, one Tata company has comes to one listed. That is for the IPO it is coming. I choose the IPO that I want to invest. Basically, to IPO requires some research, which we have a lot of historical data which we need to perform. Crucial fundamental categories and factors which we need to compare. Okay. When we compare that company to a listed company, we will take some criteria and we will take an essential first step whether I will invest in the company or whether I will not invest in the company. Once a decision is taken, I need 3 accounts: Demat account, bank account, trading account. That are the 3 A's you need. One is Demat account, bank account, and the trading account. So to invest in an IPO, like how we have cash. Let's say I am having a physical cash of 500. Now I want to make it to change it as an electronical way. That electronical way, I will go to the bank and I will insert my 500 rupees in digital format. It shows it is 500. It means the 500 is in my bank account. Like the same way, the shares which I physically want to purchase previously before 1991, it is a physical format. After 1991 and 1992, it is converted into a Demat format. That is, Demat means dematerialized form. Okay, so I want my shares to store. That's a major thing. Where you store my shares in the electronic form, that account is known as Demat account. Once you open a Demat account, automatically trading account will create to trade the shares. What is a trading account? To buy and sell the shares. Okay, you can trade. I will basically use the grow as an brokerage firm to trade my shares. Okay, then next one is bank account. What is a bank account? Why it is essential to invest in IPO? A bank account is required to infuse your fund, your share market transaction. However, bank account can come in handy to apply for an IPO as well. Almost all net banking platform, that is NEFT, basically National Electronic Fund Transfer, instant money transfer, or some of the facilities which we are having, have the facility to IPO through an application supported by blocked amount, that is known as ASBA facility. What is this known as? ASBA facility. Okay, this is a system which we block that fund till the time of allotment. Once it is allotted, that funds will be transferred to the fund house, to the brokerage firm. And if the funds are not allotted, that amount will be unblocked after the allotment date is over. Okay. What will happen after I will apply for an IPO? The process is little different. When you apply for an IPO, regardless of any method of application, the aggregate amount gets blocked from your bank account, that is known as ASBA. It will show up in your balance, but it will not available for use. That is, the money is not spent. It is only the blocked amount which will show up as a balance, but it will not available for your use. Once allotment is finalized, if you have received the shares, the amount will get debited from your account. Debited, it means already transferred to your fund account. If you have not received any shares in the IPO, the amount will be unblocked. That's what I have told to you. Okay. This is a basic thing which how you will be allocated. That's a basic thing you can easily do. That you can easily do. So now we will be getting into any one company which we will having a share market thing, which comes. Now we will go to our OneNote and we will study something, and again we will get back to our practical discussion. So we have studied about the share capital. First thing, company has decides do writing along with me. Okay, those who are watching recording also, your eyes should see what I am writing, your ears should hear, and your hand should be written. Okay, so if I do this process, you feel not like you are attending the recording session. It will be completely an interactive session with you as well. A company decides to raise a capital of, let's say, basically 1 lakh from public. Okay, then that 1 lakh, I will call them as capital. The capital is going to be how much? 1 lakh. Okay, fine. Now, I want this 1 lakh to be divided into 10,000 units. 10,000 units. Then, how much rupees it will come? It will come to 10 rupees. Correct. So, this 1 lakh we are having is known as share capital. It's known as what? Share capital. The 10,000 units, what we are having, we call them as share. 10 rupees is nothing but we will call them as face value, nominal value, or par value. Why we will call them as a nominal value or a face value is something, this kind of value which is denoted in the MOA, Memorandum of Association. In Memorandum of Association, we will treat them as a normal face value and a nominal value. That value we will say them as a thing. Next, what is a share capital? First, what is a share capital and what is a share? A share is something which is an interest in the company. Many of them say it is a money-based thing. Money is converted. It is in the money form, but what kind of interest? What percentage of the interest I am having in that company which I am going to invest? That is known as share as well as share capital. So, a share capital is a thing. Capital that rises by the company for issue of shares. For issue of shares. Then share capital or shared by the public at large. Shared by the public at large. What is a share? It is part of share capital in the company. It is one of the parts of the share capital in the company. So this is how it will works. Till this point, everything is clear. Shall we move on to the next thing?
Yes, sir.
Yes, perfect. Next. How to raise share capital? That's my next question. How to raise a share capital is my question. Let's say that's a simple thing. Step 1, what we have studied under the IPO, the same process only we are going to follow. Step 1 is, write along with me, company invites the public to apply for shares. In an application form. Now it is currently becomes completing, it's going to be an electronic form nowadays. Okay. Along with prospectus. Now it's a time to decode it. Invites public in an application form along with the prospectus. From a public, we are going to do it. That's a basic thing we do. In a share application form means I am shares I'm going to issue. How many shares I'm going to issue, what I'm going to apply. That I will indicate in this point. Prospectus is a thing which is an advertisement by company to by a company to invite to subscribe their shares. To subscribe their shares. This is a thing which you need to do. Then, what is the step 2? Public applies. Public applies or subscribes for shares in an application form. At that point, of time public is known as applicants. Now it's time to decode this. Subscribes an application form from the point of view time public known as applicants. It means subscribe means purchased, purchases or purchasing the shares of in an application form. From that point, once I have purchased or once I have applied, that public will become applicants. Okay. Now getting into step 3. Step 3. Company then gives the shares to the applicants on suitable basis. There are different methods to subscribe the shares, so I will use the word suitable basis. Then those applicants to whom shares are allotted those applicants are known as shareholders. Known as shareholders. There is many methods to issue a shares. So I will use the word suitable basis. What are the bases we will go to later, and whom the shares are allotted. Once allotment is done, that applicants now will be called them as shareholders. Here, one more important point to be noted down is number of shares subscribed in application form. It can be greater than or equal to the number of shares or less than or equal to the number of shares issued by the company. It is simply means it should be read together. Number of shares issued by the company, either it can be greater than or equal to, or either it can be less than or equal to. Greater than or equal to, we will call them as oversubscription. Less than or equal to is known as undersubscription. So basically, most of the time, oversubscription will happen. Most of the oversubscription has done recently in the IPO is Tata Technologies IPO. In Tata Technologies IPO, it has easily done. They asked somewhere around 3,000 crores. 3,000 crores of share capital only the company is asked. What our people has done now, they have given nearly around 2 lakh crores. How many crores of fund we will infuse in those only one company? It's only because of the brand image. It's only because of the brand value. It is only because of the reputation. It is for the one and only man, Ratan Tata. So Tata Technologies is one of the recent IPO which has subscribed, and it has been listed 140% the value. Basically, its value is around 500 is an IPO price. Listed price is 1,200. On the same day, it has goes to 1,400. Okay. We will getting into the practical aspects very soon. Okay. Next. Types of shares. How many types of shares are there? Can anyone tell me?
Types.
two types. What are those two types?
Equity shares and preference shares.
Equity shares and preference shares. Equity shares or ordinary shares. Sometimes in a layman's language, in a funny corporate world, we will call them as vanilla shares. That is known as plain shares. Okay. Preference shares. PS means it is preference shares. Okay. Majorly, you will use these two terms, equity shares and ordinary shares. So, first let us discuss what is preference shares. Preference shares, they have two preferences. First preference will be given to them only. That is in payment of dividend. What is the first preference? It is regarding the payment of dividend. That rate of dividend is to be fixed. And it should be slightly higher than the equity shareholders also. Okay. Many of them will having a doubt. What is dividend? Dividend. Dividend is nothing but divide the profits of the company at the year end or at the quarterly end. Basically, dividend is of two types. One is final dividend, which is after the completion of the financial year, they will distribute. That is known as final dividend. And the next one is interim dividend. Interim dividend is the thing which has done, which has paid in the current year itself. During the interim course of the business, they will pay, they will share the profits with the shareholders. Is known as interim dividend. Okay. Basically, if I want to share my experience, I am holding a shares of Vedanta Limited. Vedanta Limited is one of the company which is providing a dividend approximately 30 rupees, 30 plus rupees per year. The share value of the shares is roughly around 267. Roughly around is trading right now. 267 is roughly around it is trading. They are paying a dividend of 30, but in the current year, they have paid 50 rupees as a dividend. Basically, approximately an average value, they will pay 30. In put together, if I say this current year alone, they have paid nearly around 50 rupees. They can be interim also. It can include your final dividend also. It can be in some cases, we will also see how the practical aspects are there. Vedanta, I am holding around 30 shares I am holding right away. 30 shares, I think so. Roughly it is 30 shares, I think so. Okay. So this is how it will work. How it is practically works, we will see it later when I go for a practical view. Next, the second preferences I am having is repayment of capital at the time of liquidation. When the companies goes to, and when the company is having intention to shut down their business, that we will call them as a liquidation, and the repayment of a capital at the time of liquidation, I need to pay it as a first thing. Okay. Next, we'll getting into the next heading, equity shares. What is an equity share? An equity shares, it simply means not a preference shares. Basically, this was the definition which has been given in their module also. Okay. Basically, generally, rate of dividend, or if I want to tell specifically, rate of equity dividend is greater than rate of preference dividend. Many of them will confuse this thing. When I say preference is dividend is the thing which I get back as my consideration. If it is a debenture, it should be debenture interest preference dividend. Debenture interest preference dividend. Okay. Next, equity shares are those shares. They can participate in management of the company. They can participate in management of the company. They can participate in the voting decisions of the company. Okay. And they are to be treated as the owners of the company. They will be treated as the owners of the company. Based on the equity shares, large number of equity shareholding can become the board of directors of the company. Okay. Some cases, owners can be a board of directors of the company if the owners will also be a part of the board of directors of the company, or some persons will be called them as ID. What is an ID? Can anybody idea about ID? That is independent director. In some companies, they will appoint some independent person as a director who have an ample of knowledge about the finance, HR, and the marketing techniques, business strategies, everything. That person will treat as independent directors. He will not influenced by other directors. Whenever the board of directors is applied, they will go for a DIN. What is a DIN? DIN is something known as directors identification number. Directors identification number. Each and every company will have a SIN. What is a SIN? Corporate identity number. Corporate identity number. Okay, this was a thing which I want to discuss with you. Then when we go further, the most important thing which we will be discussing is issue price. What is an issue price? Darshini, can you tell what is an issue price?
The price at which the share is issued.
Very good. Price at which company issues shares, or based on the demand of the share, based on the subscription types of the share, that is oversubscribed the shares, it will also determine the issue price. That is price at which public subscribe for shares. Okay. So basically it have two. Or that I will simply bifurcate it as shares can be issued by company in two ways. One is at NB, at nominal value, or at greater than nominal value. That is face value. If it is at nominal value, my invoice price is equal to nominal value. In practical scenario, this will never works. Okay. At greater than normal value, that is invoice price is greater than nominal value. This will only in practical word it will works. Okay. invoice price is equal to nominal value, or wait, invoice price minus nominal value is equal to. It means that extra amount, correct? Let's say my invoice issue price is 100, my nominal value is 10. 100 minus 10 is equal to what? 90. It is an extra amount, correct? That extra amount asked by the company from whom? From public, correct? Is known as securities premium. Is known as what? Securities premium. Okay. One more thing. One more important note which you need to note down. Company cannot issue shares at below nominal value, that is at discount price, at discount to public. There is some exception to it. As per section 53, I think so. Yes. As per section 53, that is an exception. A company can issue shares to the public except in case of sweat equity. Only in case of sweat equity shares, they can issue the shares at discount to the public. Are you able to understood? Shall we go for the security premium topic?
Yes, sir.
Yes. Now our next topic is securities premium. This securities premium, if I want to discuss here, as I already said, it is an amount which is asked by the company above nominal value. Okay. Since security premium is received from the owners of the company, that is from the shareholders of the company, this securities premium is shown as, listen to this point, this will leads to a next module in your books. So securities premium is shown as part of owner's fund. This part of owner's fund, as per schedule 3 of the Companies Act, we will treat them as shareholders fund. We will treat them as shareholders fund. Okay. And that shareholders fund, under the category, subcategory, we will show them as reserves and surplus. This securities premium will be showed under the category of reserves and surplus. The major heading will be shareholders fund. Okay. Next important thing. Security premium should always be calculated as a percentage of nominal value of shares. It should be computed as percentage of nominal value of shares. Okay. And most important things is come, that is section 52 of Companies Act 2013. That is uses of securities premium. How you can utilize the securities premium. or if I want to use the word utilization of securities premium. Basically, it can be utilized based on 5. First one, for issue of bonus shares, that is free shares. Okay. Second one, for writing of preliminary expenses. That is pre-incorporation expenses is known as preliminary expenses. Some documentation charges are there, some charges which we want to pay to MCA. That's are the different charges which is treated as preliminary expenses. That preliminary expenses is known as pre-incorporation expenses. That expenses we can use that securities premium, that extra amount which I collected from the public, I can use to write offing it. Then third one, for writing of commission or brokerage paid for issue of, even in case of shares or debentures. In both the ways we can use. Fourth one, for writing of premium on redemption of debentures. Premium on redemption of debentures. This securities premium will be a most important part in this chapter. Redemption of debentures or redemption of shares. Because bonus shares, we are having a separate topic. To issue of shares, we are studying. Issue of debentures, which we are going to study. Premium on redemption of debentures is another exclusive topic we are having for our discussion. Redemption of shares is also a different topic we are taking for our discussion at the later part of this chapter. Okay. And for writing of loss on buyback of shares. Loss on buyback of the shares. This is also another chapter which we will be discussing in the later part, that is known as buyback of shares. So this section 52 is more and more important from your exam point of view, especially in this chapter. Okay, so let's go for the simple journal entry and a structure, and then we will go for a practical view, and then we will close off with this session. Okay. What is the journal entry for issue of shares? Okay. I will divide basically into two. One is at par, one is at premium. Okay. Can you tell Darshini what is at par, how the journal entry will be? Those who are watching this recording also can participate in this. What is meant by at par DS and what is meant by at premium? What is a journal entry?
I think bank to share capital.
Yeah, that's a thing which we say is a bank to share capital is the thing which I have learned it from our 11th and 12th itself. But it is not actually doesn't want to be only the bank, right? Even it can be other things also. So the basic journal entry is something which we get. That is, we will write them as consideration account debit to share capital. You may wonder why it is consideration. What is the consideration you have learned? Consideration means which is something in return, correct? Is it
Yes,
right?
sir.
Yes. If I pay cash, I will get shares. At the time, I will pass the entry bank to share capital. I will pay my asset worth of machinery worth of 1 lakh and I will get shares of 1 lakh worth. At the time, I will pass the entry machinery to share capital. because share capital is something which is having a liability towards the company. This everything you need to study from the company's point of view, because it is a corporate accounting. Each and every aspect should be studied from a corporate point of view, not from an individual point of view. So share capital is a liability which he needs to repay towards the equity shareholders. So this is a liability thing which has been increased as per modern approach. If liability increasing, we need to credit it. Okay, consideration is something which I pay or which the company will get. Okay, so at the time, if the consideration is increases, that the company is getting some money. Okay, so if the company is getting some money, that is, his asset balance will increase, asset balance is increased, it is known as, we will debit it. Then at premium, we will treat them as same thing, consideration account debit to share capital account to securities premium. To securities premium. This should be based on the nominal value. This should be securities premium. Suppose nominal value is 10, issue price is 15. So I will put consideration as 15, nominal value as 10, securities premium as 5. That is 15 minus 10, which is equal to 5. This 5 is known as securities premium. This is how it will works. Okay. So many of them will have a confusion that why I use this, because those who have studied already with us, they know. But for this batch, I will tell you, I will use the word as per new modern approach, that is dealer. What is a dealer? D means you can treat them as drawings. E means an expenses. A means an asset. Asset inclusive of cash, inclusive of bank, inclusive of stock, inclusive of machinery, inclusive of land, inclusive of building, everything. Debtors, bills of exchange, that is bills receivable, prepaid expenses, everything will comes under the categories of asset. L means liabilities. E means equity or capital. R means revenue or income. This as in expenses inclusive of losses, revenues is inclusive of gains. That's what we will assume. This is a modern approach. This is a word I have given for your remembering purpose, memory purpose. This is not the same word which is there existing there anything. If this three things is increased, as per approach, we will debit. If it decrease, we will simply credit. If these three things are increasing, we will credit. The liability is being created. If it has been decreasing, the liability has been reduced. That is, we will debit it. So this is as per the modern approach of accounting we will use. A traditional approach will comes to mind that which account I need to put, whether it is a real account or personal or nominal. There will be some confusion will be there. So if I go for a modern approach, there will be no confusion. If it is an expenses, I will simply put them in debit and we simply put them in credit. Okay, if it is increasing, if it is decreasing. So this is a thing I want to discuss it today. And the next topic for our tomorrow is structure of share capital, how it will works, everything we will say, and what are the methods of issuing a share. That's everything we will see. Just slightly, we will getting into the practical aspects of the thing. So basically, I will just getting into Vedanta Limited. As I already tell, it is somewhere around trading at 6267. Okay, that's amount it has been traded. As I already tell, I have purchased this shares at 30 share at a somewhere rate around 280.19. Okay, so it is currently trading below. But if I go for the events thing, if I calculate the dividends part alone, which has issued in 2023. Okay, If you took 12.5, 20.5, 18.5, 11 rupees recently, which has paid few days before, that is 27 December. Each and every dividend is an interim dividend. Each and every dividend is what? Interim dividend. Okay. If you calculate this value 12.5, 20.5, 18.5 and 11, it somewhere comes around 50 rupees. So that's what, even though company is traded below the value, I have purchased the value, right? If you were recently, if you purchase this shares somewhere around somewhere around October or September of 2023, it has been traded around at exactly 212 or 202 rupees. Exactly the value will be. Even you can get a premium of 50 rupees along with the dividend of extra 10 to 20 rupees extra. So it is advisable that based on the stocks what you have chosen, you can do an investing process. Okay, suppose if I will take an IPO. Okay, so we will go for something just already gets listed. If I want to tell, yeah, as I already tell, we will go for Tata Technologies. Yeah, Tata Technologies is a thing which I am taking. First, at Tata Technologies, if I take, as I already tell you, it is listed on two stock exchanges, BSE, NSE. What is an issue price of this? 500 is the issue price. Listing price can be at any price based on the demand, based on the supply. It has been done. What is the listing price? 1200 is the listing price. What is the listing gain? Difference between this gain? 700. This 700 is based on 500. How many percent? It is 140%. So it is 1200. But do you know one thing? On the same day, it reaches to 1400. On the same day, you can check with the past analysis also. Okay. Next. This bidding dates is open from 22, 23 and 24. Basically, 3 days. What is the minimum investment I required? 14 to 50 is the minimum requirement which I required. It is 30. Okay, 30 into 500 if you put. The minimum investment is something which is a thing of 30 into 475. There's a minimum range they will fixed. Okay, that's how minimum investment. But actually IPO will be allocated based on the thing which is of into 500. I need minimum 15,000. That is, as a ASBA facility, I need to block it in my bank account to issue the shares. What is the issue size? I already discussed, if somewhere around 3,000 crores, exactly 3,042.51 crores. But what is actually happened? Qualified institutional buyers subscribed around 203.41 times. Non-institutional investors 62.1 times. Retail investors 16.5. And the employees, this is how we have an exclusive plan called ESOP, employee stock option plan. They have subscribed around 3 point sometimes. In total, if you take it, it will comes around 69.43. Just simply multiply 3042 into 69. What it will comes? Somewhere around 2,09,898 crore rupees we have given as a subscription. This is a completely and oversubscribed. Okay, this is how it will work. And if I want to know one more thing, we'll go for a RHP. What is an RHP? RHP is nothing but red herring prospectus, which you already learned, no? There's a two types of prospectus. One is shelf prospectus and one is red herring prospectus. Basically, when we go for an subscription, it is basically of two types. Okay. One is fixed price method and the next one is book building method. One is what? fixed price method, and the next one is called book building method. Is it, I'm audible right now?
Yes, sir.
Yes. Yes. So, what is book building method? A fixed price method is something which is already predetermined price, which I already fixed the price and I will ask the money from the public. But what is book building method is something when shares are not offered to the public at any predetermined price, but the final share value will only be gets collected. After collecting the bids, I will fix the price, but it is basically of price bet. From this price to this price, I need my shares should be there. If some person is ready to invest it at 480 rupees, basically in Tata Technologies, what is the price brand? 475 to 500. This is how the method called book building method. Okay, the price band which is having a minimum price that is 475 is known as floor price. Is known as is what? Floor price. And the maximum price is known as what? Cap price. Minimum price is known as what? Floor price. Maximum price is known as what? Cap price. They can bid in with this price band, they can bid their offer. Okay. The price at which shares are allocated that is on the issue price, that issue price is known as cut-off price. That issue price, or if I want to tell specifically, write down in your notebook, the price at which the shares are ultimately allotted is known as called cut-off price. Is known as cut-off price. They have followed the book building method only. Okay. If I want to tell specifically, yes, now it's open right now. We'll be discussing. Yeah. As I already discussed with you, there is something called red herring prospectus. It should be read as per section 32 of the act. It is 100% book build offer. That's what I tell. It is a book building method. Okay. This what I have already discussed. CIN, corporate identification number. Okay. So if U means it is unlisted. Okay. U means it is unlisted. And it's followed by a 15 to corporate 20 digits identification number. Then registered office and corporate office. What is this? There is a registered office of Rajiv Gandhi Infotech Park, Maharashtra. Who is the contact person? That is Vikrant Gandhi. That is a CS. That is a company secretary and the compliance officer. The email ID and the telephone is a public document which is available to everyone. Okay, ipo.technologies.com and there's a telephone number is given. If I want to get more about the thing, I will go for that website. And the promoters of our company is Tata Motors Limited. Who is a major promoter of the company? Tata Motors Limited. It is a subsidiary of the Tata Technologies Limited. Okay, what is OFS? That I never discussed with you. Okay, OIS is something. Okay. OIS is something which is offer for sale. Offer for sale is something which I already having no. That which are the oldest shareholders. They are already a shareholder. Okay. That shareholder is ready to sell their shares. It is completely of the offer for sale type. Fresh issue size not applicable. Fresh issue they never come. Those who are already, because Tata Technologies is an unlisted company which is already having some person who is holding the shares as it is a public company. Okay. And that shares they are ready to offer to that sale to that public. So we will say them as offer for sale. That is, they will ready to sell their shareholdings. That ready for sale, offer for sale is known as that share entire equity shares is roughly around 60 lakh. That is 6 crore 8 lakh 50,278 equity shares. This dot is that was mentioned about the book building process. They will fix it later at that time. Okay, they never fix right now. What is the eligibility? They will follow with the Regulation 6 Class 1 of the Securities Exchange Board of India, Issues and Capital Disclosure Requirements Regulation 2018. These are rules they need to follow. QAB means qualified institutional buyers, non-institutional buyers, regional retail institutional investors. That's different things we will be having. Okay, then we will be having is under the discussion of the details of the offer for the share by the selling shareholders and the respective weighted average cost of acquisition. This is what you have studied in your, you will be studying in your financial management WACC. Weighted average cost of capital, weighted average cost of acquisition. These are the different things you will be studying. Okay. Then this Tata Motors Limited is a promoter and a selling shareholder is having 4 crores 62 lakh 75,000 equity shares at a weighted average cost per equity share is roughly around 7.4 rupees. It's a weighted average cost. And Alpha TC Holdings Private Limited is an investor selling shareholder is roughly around 97 lakh 16,000 853 equity shares, aggregating the per value of the share is 25.10. Did you believe they are offering at 25.10? They are getting back at 1,500 rupees as an issue price. How it will actually works? Okay. Then Tata Capital Growth Fund. It is a mutual fund which is comes under the qualified institutional investors category, roughly around this number of shares. And this everything is certified by Mannain and Rao, chartered accountants, pursuing to their certificate dated on 13th November. So it is should be certified by that professional. Okay, they will also use the book building process as a basis of offer. What is the face value or a nominal value of equity share? It is 2 rupees. The floor price, the cap price, the offer price, everything. That's what I say. It is comes under the book building category, book building process method. What is the general risk what we are having? Everything has been discussed here. What is the companies and the selling absolute? What is the responsibility? Why they are selling? What is the general risk they are having? What is the listing? Basically, they are going to list it in two types. One is BSE as well as in NSE. Do you know one thing? The BSE and NSE are also a companies. Bombay Stock Exchange Limited and National Stock Exchange is a limited. BSE is already a listed company in the BSE and NSE. NSE is not even listed. It is yet to be listed in the near future. Okay, for this purpose of this offer, what is the main designated stock exchange? BSE Limited is a designated stock exchange. Okay, book running leading managers. Those are known as who done this process. The company will not go into the shoes of the shareholder and they will do this process. It has been done by different institutional or security brokerage firms and securities lending firms. That is JM Financial Limited, who is a contact person. What is that thing? And BofA Securities Limited India and Citi Group Global India Limited. That is Harsh Agarwal will be there. And what is the register office? The registrar to the offer. Sorry, the registrar to the offer is known as Link In Time India Private Limited. Shanti Gopalakrishnan is who is the name of a contact person and this offer. When the bid and offer program will start, November 21 it will start, November 22 it will ends, and Friday 24 that is bid offer. That is it is anchor investors known as pre-period. The offer will be opened before for that some of the exclaimed kind of shareholders. That is known as November 21. Actual bid opens is known as November 2020, November 22, and November 24 is a bid closer. That's what we have also discussed. And this is a promoter, how it will works, everything, where is the registered office, everything they have given. Okay. So the same thing which I have given, the same perspective they have given it over here. And this is how, what's the general information, risk factors. They will use the hyperlink. So if you press it, it will goes to the immediate to the next page. Okay, this I will also upload it in my app. Those who want to study this prospectus, they can download from the app and they can study this. Okay, I don't, it's nearly roughly around 504 pages, my dear. How I can explain each and everything in this classroom itself? It will itself will go really for 30 hours if I explain each and everything. Okay, so if you want to study anything about a company, financial information, what is the legal information, what is the debt they are having, each and everything, if you want to read, you can learn it from this document. It is available. If you want, you can easily download, or if you want this same documents to be studied, you can download our app, RE Academy CACS CMA app. In that free material description, I have given this app. You can download it and you can watch this. Okay, this is a discussion which I want to close by today. Okay, from tomorrow's class, we will be getting into the another theoretical as well as some practical aspects towards the subject of corporate accounting. Okay, and that is an issue of shares and forfeiture of shares. And then we will be move on to our practical sum point of view. Okay, the law should be studied and the accounting should be studied for life. It should not be studied only towards the marks. You should learn the concepts. You should learn each and everything towards the concepts. Okay, that's what for today class. We will meet up tomorrow and we will be doing our further things. Okay, before coming to the next class, revise all these things, and if you have any doubts, you will come up with tomorrow's session. Thank you. Have a nice day, dears.